You can collect triple the premium of an iron condor with the exact same buying power using an iron butterfly, but it technically has a lower probability of profit. Why would anyone trade a strategy that loses more often? It comes down to risk to reward. While the iron condor we covered in Phase 5 picks up pennies in front of a steamroller, the iron butterfly steps directly in front of the steamroller but wears heavy armor. By converging your short strikes at the money, you are selling the absolute maximum extrinsic value possible in the option chain. But here is the twist that traps new traders. That massive credit creates an illusion of safety. You see a $5 credit and think you have a huge buffer. However, because your short strikes are at the exact same price, the stock effectively has to stay motionless for you to keep it all. You have traded probability of profit for maximum profit potential. Let's construct it to see the mechanics. You are essentially selling an ATM straddle, then buying OTM wings to define your risk. This caps your loss if the stock makes a massive move, unlike the naked straddle we discussed in episode 48. However, the placement of those wings determines your Vega exposure, something we will calculate in a moment. The math behind your safety net is specific. Your upper and lower break-even points are simply your short strike plus or minus the net credit received. Note that while this is wider than a naked straddle's break-even, it is significantly tighter than a condor. You need to know these numbers before entering the trade. So when do you deploy this? Only in high IV rank environments, ideally above 50. You aren't looking to hold this to expiration to capture that narrow peak profit. You are hunting for an IV crush. When volatility collapses, the inflated premiums you sold deflate rapidly, allowing you to close early for a 25 to 50% profit regardless of minor price movement. Master the volatility crush, but respect the narrow path to profit.